What if everything you thought you knew about silver was about to be turned completely upside down? What if the quiet, patient metal sitting in your safe or the silver position you've been holding in your portfolio is sitting directly on top of a pressure cooker that is about to blow? And most people, even most silver owners, have absolutely no idea how close we are to the moment when everything changes. Because right now, there is a warning flashing in the silver market. And not just any warning, a major one, the kind of signal that when you look back at previous turning points in precious metals history, you almost always see in the rearview mirror and say, that was the moment. That was when everything shifted. That was when the people who were paying attention made life-changing decisions, and the people who weren't didn't. So, if you own silver, or if you've been thinking about silver, or even if you're just trying to figure out what on earth is happening in the financial world right now, you need to stay with me through this entire video, because what I'm about to lay out for you is going to fundamentally change the way you see this market. Let me start with a question. If I told you that the silver market has been running a structural deficit, meaning the world is consuming more silver than it is producing, for 6 consecutive years in a row, what would you expect to happen to the price? Any economist, any first-year finance student, any vegetable stand owner who understands basic supply and demand would tell you the same thing. If you keep taking more out of a bucket than you're putting in, eventually the bucket runs dry. And that's exactly what's happening right now in the global silver market. And the consequences of that reality are only just beginning to be felt. Now, before we go deeper into this, if you're watching this and you're someone who's worked hard their whole life, built a retirement nest egg, and you're trying to figure out how to protect it from all the chaos going on right now, the dollar losing purchasing power, geopolitical tensions, market volatility, I put together a free guide that goes into the specific saving strategies that thousands of American retirees are already using to protect their hard-earned wealth. It's completely free. Just check the description below and grab it before you leave. Now let's get back to what's happening in the silver market, because this is urgent. 6 years, 6 consecutive years of deficit. Think about what that actually means in real terms. According to the Silver Institute's most recent world survey, global demand for silver is running well above 1.1 billion ounces per year. Mining output, even with recent increases, sits around 846 million ounces. And even when you throw in recycled silver, which has been hitting multi-year highs as higher prices incentivize people to melt down old silverware and industrial scrap, the market still comes up short. The accumulated deficit over the past 5 years alone has now surpassed 800 million ounces. 800 million ounces of silver that the world needed, that did not exist in new production, that had to come from somewhere, from vaults, from ETFs, from warehouses, from the deep storage of the financial system itself. And that somewhere is getting harder and harder to find. Now, here's where it gets really interesting and really alarming for people who aren't paying attention. The silver that flows through the global financial system doesn't just sit in a big pile somewhere. It moves through a series of warehouses and exchanges, the most important of which, for American investors, is the COMEX, the commodity exchange operated by the CME Group in New York. The COMEX is where silver futures contracts are traded, paper promises to buy or deliver silver at some future date. And for decades, the whole system worked because of a critical assumption. Most people who traded paper silver never actually wanted the physical metal. They would roll their contracts, sell them, take their profits or losses in cash, and move on. The actual silver in the warehouses was just there as a backstop, a safety valve, a proof that the whole system wasn't one giant bluff. But something has been changing, and changing rapidly. People are increasingly standing for delivery instead of rolling their futures contracts or cashing out. A growing number of buyers, and these aren't small retail investors, these are institutional players with the muscle to take delivery of thousands of ounces at a time, are showing up at the COMEX and saying, "Give me the silver, give me the physical bars, we want the real thing." And every time they do that, registered COMEX inventories drop. Right now, the amount of silver sitting in COMEX registered vaults, the silver that is actually available for delivery, is sitting at a fraction of what it was at its peak. Total COMEX inventory has fallen dramatically from its highs, with eligible stocks continuing to drain. The ratio of paper claims to physical silver available for immediate delivery has become, frankly, alarming. And when you start to understand the mechanics of how this market works, you begin to realize that this is not a small technicality. This is the very foundation of the global silver pricing system, and it is under stress. Let me give you a historical parallel to make this real. Think back to what happened in the gold market in the early 1970s. For decades after World War II, the entire global financial system operated on a simple promise. The U.S. dollar was backed by gold at a fixed price, and any foreign government could walk up to the U.S. Treasury and exchange their dollars for gold at that rate. Simple enough. Except that over the 1950s and 1960s, the United States spent enormous amounts of money on the Great Society programs, on the Vietnam War, on the general expansion of the welfare state, and they printed more dollars than they had gold to back. For years, the gap between the paper promise and the physical reality grew larger and larger. Most people didn't notice. Most economists said, "Don't worry about it." And then in 1971, everything broke at once. France and several other nations had been quietly exchanging their dollars for gold, watching the U.S. gold reserves drain. And when it became clear the jig was up, President Nixon closed the gold window. The promise was broken, and within a decade, gold went from around $35 per ounce to over $800. That's what happens when a paper promise and a physical reality are suddenly forced to reconcile. Now, I'm not saying the exact same thing is about to happen in the silver market tomorrow. What I'm saying is that the structural dynamic, too much paper, too little physical, and a growing number of sophisticated players who know it, rhymes very closely with what we've seen at major inflection points throughout monetary history. And the people who understood those dynamics early, who positioned themselves before the moment of reckoning arrived, are the ones who look back on those periods as the defining financial events of their lives. Let's talk about why industrial demand is pouring gasoline on an already dangerous fire. Because here's the thing about silver that separates it from every other precious metal in the world. Gold is primarily a monetary metal. People hold it as a store of value. Central banks stack it in vaults. Investors buy it during times of crisis. But silver? Silver is the ultimate dual-threat asset. It's both a monetary metal and a critical industrial commodity. And the industrial side of this equation is where the story gets truly explosive right now. Industrial uses account for well over half of all silver consumed every single year. And not just any industrial uses. We're talking about the foundational technologies of the 21st century economy. Solar panels, electric vehicles, artificial intelligence, semiconductors, 5G infrastructure. Every single solar panel manufactured requires silver. Silver that conducts electricity better than any other metal on the planet. Silver that cannot be easily substituted without significant loss of efficiency. The share of total silver demand coming from solar photovoltaic production alone has skyrocketed over the past decade from around 11% to nearly 30%. And as governments around the world have committed to ambitious green energy targets, as solar installations are being deployed at record rates across Asia, Europe, and the United States, that figure is projected to keep climbing. Then there are electric vehicles. A modern electric vehicle uses somewhere between 3 and 5 times more silver than a conventional internal combustion engine car. Every EV has a sophisticated electrical system packed with silver-containing components, from the battery management system to the charging infrastructure to the onboard electronics. The Silver Institute projects that automotive silver demand will grow at a compound annual rate of over 3% through the rest of this decade, with EVs dominating that growth. And here's the kicker. By the time you add up the solar panels powering the grid, the EVs drawing from that grid, the AI data centers requiring massive new electrical infrastructure, and the military and aerospace applications that have been quietly expanding their silver consumption, you're looking at a demand profile that is structurally disconnected from anything that existed even 10 years ago. Scientific projections from peer-reviewed research suggest that by the end of this decade, total silver demand could reach levels that existing supply can only cover 60 to 70% of. That means a potential shortage of 30 to 40% of total demand. Let that sink in for a moment. A metal that is already running a 6-year deficit, with above-ground inventories already depleted, now faces a demand profile from the energy transition alone that could make current deficits look tiny by comparison. There is no mine in the world that can be built fast enough to solve this problem. Silver mines take 7 to 10 years from discovery to production. The problem is structural. It is baked in, and it is accelerating. Now, let's talk about something that most retail silver investors completely miss. Around 70% of all silver mined in the world is produced as a byproduct of mining other metals: copper, lead, zinc, gold. Silver is not the primary product in most of the mines that produce it. It's what comes out of the ground alongside something else. This means that silver supply is not directly responsive to the silver price. Even if silver's price doubles, triples, quadruples, most of the mines producing silver aren't going to suddenly ramp up output, because they're not silver mines, they're copper mines or lead mines, and their production decisions are driven by the prices of their primary metals. The inelasticity of silver supply is one of the most powerful and underappreciated dynamics in the entire precious metals market. Demand can explode, and supply simply cannot respond fast enough to meet it. That's a recipe not just for a price increase, but for a price explosion. Let me tell you about what happened in 1980, because there are eerie echoes of that moment in what we're seeing today. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt spent the late 1970s accumulating silver. They understood that the paper money system was under stress, that inflation was raging, that the Federal Reserve had spent years printing money to finance government deficits. They bought physical silver. They bought futures contracts and stood for delivery. They pulled metal out of the global system and sat on it. And as their buying intensified, as word spread that someone was cornering the physical supply, a feedback loop developed. Other investors bought in, industrial users scrambled to secure supply, and silver's price ran from roughly $2 an ounce at the start of the decade to nearly $50 an ounce by January of 1980, a 25-fold increase in roughly 3 years. Now, the Hunt brothers' story ended badly. The COMEX changed its rules in the middle of the game to stop them. Margin requirements were dramatically increased and prices crashed. And I want to be very clear, I am not suggesting that anyone go out and try to corner the silver market. What I am saying is that the lesson of that period is timeless. When the gap between paper silver claims and physical availability becomes too large, when enough players with enough capital begin to understand and act on that gap, the paper price of silver can move with breathtaking speed and ferocity. The Hunt brothers were two individuals acting in concert. What we're looking at today is something potentially far more diffuse and far more powerful. A combination of industrial demand, institutional accumulation, geopolitical shifts, and retail awakening, all converging simultaneously on a market that has been structurally constrained for years. Speaking of geopolitical shifts, let's talk about something that has been flying almost entirely under the radar of mainstream financial media: China. For most of the last decade, China has been both a major producer and a major exporter of silver. Chinese silver flowed out to global markets, helping to keep the physical supply picture from becoming crisis level. But in recent periods, something has changed dramatically. China has been restricting its silver exports. The country that once supplied significant portions of the global physical silver market is now holding more of its silver at home. Why? Think about what China needs for its own energy transition, its own massive solar manufacturing base, its own EV industry. Think about what a country that is deliberately positioning itself in competition with the United States might want to do with critical minerals in a world where those minerals are increasingly the foundation of military and economic power. China restricting silver exports is not an accident. It is strategy. And for the rest of the world, which was counting on that silver supply to balance the market, it is a structural problem that isn't going away. This dovetails with a broader geopolitical trend that anyone with retirement savings needs to understand. We are living through a reorganization of the global financial order. The dominance of the U.S. dollar as the world's reserve currency, which has been the bedrock of American financial power and the primary mechanism by which the United States has been able to run massive deficits without immediately suffering the consequences, is being actively challenged. BRICS nations have been openly discussing alternatives to dollar-dominated trade. Central banks around the world have been accumulating gold at the fastest pace in decades. Bilateral trade agreements are increasingly being settled in currencies other than the dollar. The infrastructure of a post-dollar world is being quietly assembled piece by piece, and most Americans have no idea it's happening. This matters for silver, Because silver has historically been money. Not the abstract paper money we use today, but real money. The kind that held its value across generations, across empires, across the collapse of currencies that everyone assumed were permanent. Throughout most of human history, silver was the everyday currency of commerce. Gold was for kings and central banks. Silver was for merchants and farmers and working people. When the monetary system comes under stress, and the warning signs of that stress are flashing all around us right now, people rediscover the monetary metals. And silver, because it is still dramatically underpriced relative to gold by historical standards, has the potential to play catch-up in a way that could be genuinely spectacular. Here's a way to put that in perspective. Throughout history, the naturally occurring ratio of gold to silver in the Earth's crust is roughly 15 to 1. That is, for every ounce of gold in the ground, there are approximately 15 ounces of silver. For most of monetary history, the gold-to-silver price ratio traded in a range that reflected this natural abundance, somewhere between 12 and 20 ounces of silver to buy 1 ounce of gold. Today, that ratio sits around 60 to 1, meaning it takes 60 ounces of silver to buy a single ounce of gold. Even at recent elevated silver prices, you still need 60 ounces of silver to match the value of 1 ounce of gold. If that ratio were to revert even partially toward its historical mean, say to 40 to 1 or 30 to 1, let alone the historical 15 to 1, the implications for silver's price would be profound, not just impressive, profound. The kind of move that changes portfolios. The kind of move that, for someone who has thoughtfully positioned themselves in physical silver as part of a retirement strategy, could be genuinely life-altering. And here's where I want to talk about something that is especially important for people who are thinking about retirement security. Because the warning I'm describing isn't just about silver going up. The warning is about what happens to everything else if silver's message, the message embedded in the deficit numbers, in the COMEX inventory drain, in the industrial demand explosion, in the geopolitical realignment, turns out to be right. Because if silver is right, it means the currency system is under more stress than most people think. It means the stock market, denominated in dollars that may be losing purchasing power faster than the official numbers suggest, may be delivering a much smaller real return than it appears. It means that a retirement account full of paper assets, stocks, bonds, mutual funds, target date funds, may be providing far less actual protection than people are counting on. Real protection, the kind that holds its value when currencies fail and governments print, has always been physical precious metals. And this is why, for people sitting on substantial retirement savings, particularly those in traditional IRAs or 401ks, the question of whether to have some allocation to physical precious metals is not a speculative question. It's a question about wealth preservation. It's a question about whether the years of work and sacrifice that went into building that retirement nest egg will actually be there in real purchasing power terms when you need it. Quick aside, if you're sitting on a substantial amount in your retirement accounts and you've been thinking about this, I want you to know there's a way to hold physical gold and silver directly inside a retirement account structure called a Precious Metals IRA or Gold IRA. Without triggering taxes or penalties on the transfer, there are specific rules, specific custodians, specific approved depositories. And if you do it wrong, it can create a tax nightmare. If you want to understand exactly how this works, what the rules are, how thousands of retirees are already using this structure to protect their hard-earned wealth from what's happening right now and what may be coming, market volatility, currency debasement, geopolitical instability, that free guide in the description covers it all. Worth 5 minutes of your time. Okay, back to where this silver story is heading. Let me pull all these threads together because I want to make sure you leave this video with a complete picture of what we're actually looking at. On the supply side, you have a market that has been in deficit for 6 consecutive years. Accumulated shortfalls of over 800 million ounces. Mining output that is structurally constrained and can't respond quickly to price signals. China, pulling back from its role as a global silver supplier. Recycling running at near-record levels and still not filling the gap. On the demand side, you have industrial consumption representing well over half of all silver usage, and that industrial demand is being driven by the technologies that the entire world has committed to building out over the next decade. Solar energy, electric vehicles, artificial intelligence infrastructure, advanced semiconductors. These are not speculative demand drivers. These are contracts already signed, factories already built, government mandates already in place. This demand is coming. And then on top of the industrial demand, you have the monetary and investment demand beginning to awaken. Institutional players standing for physical delivery at COMEX. Precious metals, ETFs seeing inflows. Retail investors globally beginning to understand what they've been missing. And the kicker, the thing that brings all of this together into the warning I mentioned at the beginning of this video, is the COMEX itself. The system that prices silver for the entire world is a paper system layered on top of a shrinking physical base. As registered inventories drain, as the ratio of paper contracts to deliverable metal becomes increasingly stretched, the pressure builds. At some point, and no one can tell you exactly when, but the trajectory is clear, that pressure finds a release valve. And when it does, when the paper price is forced to reconcile with physical reality, it doesn't do it slowly and gracefully. It does it the way all compressed pressure releases, suddenly and completely.